Good morning, everybody, and Merry Christmas. It is December 23, Friday. We have one more bit of economic news to come out today, the PCE inflation index prior to the open, and a little bit more peaceful today as far as everything energy, tonality, because yesterday was an absolute shocker. We produce a better than expected GDP number, and while the bond yields had absolutely no movement whatsoever, as if they are already indicating that there is no further rate hikes, the market dropped. And over in the spread room, like I say, I give out the details all there prior to the open, where the safe is, where the actual safe is, where the lower safe is, where your risk is. And yesterday's rug pull was just something I have not experienced. Let me remove these studies in years. I mean, we opened up here, and yeah, we knew we were going to get a red day. You don't get two green days in a row. But the way that this thing just continued to crater off all there until 1:30, absolutely just dumbfounded watching this. And then you turn around and you close green above those break levels. And again, this is why I try and put those safe edges out, that, using the safe edges, where they're at, where they're at, where they're at, what you're getting. And those things exploded. They exploded to such an extent that you were getting, 60%, 90%, 100%, 150%. Eventually, at the end of the day, you had to just go there and say, you know what, I have to do this. And you were talking there at, nearly 185% on those 37.95s. 38.22s, they worked. Again, same thing. The UT Miner took them at 365. Just an absolutely wild day. So, anyway, I'm just going to go over a little bit of a summary here of a couple of things as we go into the holidays. I know very few people are going to be trading. Uh, Presidential cycle theory, the election cycle theory. It's a theory that suggests that the market performs best in the second half of a presidential term when the sitting president tries to boost the economy to get reelected. Now, Joe Biden's second term started a month ago. Hence, we got that run up to 4,100 twice. You have other stats that produce, which Matt shared with me, and I had already seen these, talking like the year after the NASDAQ drops 20% or more, there's a 50-50 split between how it performs afterwards. However, when you are going into the third year of a presidential sitting, their third year of their presidential term, you had 2002, which ran 50%. 2008 was the end of what's his name, Bush, and the start of Obama. Obama was elected in 2008. You already know what 2008 was, and that's where we're going to start when I go over the chart here. And you had a 43% return over there on the NASDAQ on that year. So again, there's a lot out there that is strongly supporting everything that we're looking at. And then you come over here again and you start looking at the third year of a presidential sit, whether they're a Democrat or a Republican, since 1944. And again, there's a 70%, 78% of the time it is up, and it's up on an average of 13% on average. The Santa Claus rally. Now, the Santa Claus rally was, again, it's a theory that came out from Yale Hirsch that was produced in 1972 in the Stock Traders Almanac, about how it's 7 days. It's the final 5 days of December, which starts into the first two trading days of the following year. And he has a lot of reasons, increased investor purchases in anticipation of the January effect, lighter volume due to holidays, a slowdown in tax loss harvesting, and short sellers, pessimistic investors, they tend to go on vacation around the holidays, so they're not around. So we come over and we start looking at where our charts are, and I've gone back uh, yesterday in history and already done it for us. And I'll drop the RSI down, which I'll go over later. 2008, after we hit that double top to the dot-com highs, we ran 4.4 from December 18th into the end of the year. Over in 2000, that was 2007, apologies. 2008, we had 10.12% from December 29th to January. Then obviously we had our big bottom there in 2009, and we start to produce forward. Over here in 2010, a 5% run from December 18th, 8% run from November 2011, already in the start of our big trigger. And see here from it continued to run further as we went up higher. You did not have your major sell-off as you were coming in close to the end of the year, similar to like what we have over here in 2008. Come over here in 2012, you had a 68% run December 19th, and as you can see, continue to progress higher up until around April. Over here in 2012, produce. 2012 did not produce. You had a minus 3.43% drop from December 18th into the end of the year. And from that, as you can clearly see, one direction. 2014, 4.6% from December 18th onward. Scroll over. Use a scroll bar. This is stupid. Here you are. 6.3%, 6.13% from December 16th over here in 2014. 2015, 3.8% from December 18th. This was when we had our very first interest rate hike in that December. And we did have a lot of volatility during that year because we had that plateau up at 2120, 2080 supporting, and then we had the big Lucy sport sell off. Then you had your February 11th drop when crude oil dropped down to $26. And over here in 2018, again, or 2016, minus 1.77% from December 27th into the end of the year. And I remember this because we were running the 32 trades at that time. This was all the tech stocks that sold off into the end of the year because it was thought that Trump was against them and his policies would be negative towards the NASDAQ stocks. And as you know, the NASDAQ weighs a lot more than the Dow. The Dow stocks were running. The NASDAQ stocks all sold off at the end of that year. Trump's very first, not even taking his position yet, which again, I'll go and correct myself. Joe Biden's third year doesn't start until January because he didn't actually become president until January, even though he was elected in November. So anyway, I'm wrong with that. 2017, 1.62% from December 14th. Many of you may remember December 2017. As we continued to climb up the entire year, we never had any major movement other than the drop that we had there in March of 3% and the really quick drop that we had back in August of around 3%. Other than that, we were just on a continuous climb upward the entire year of 2017. 2018, from the drop, and we bottomed at 20% from the all-time highs on December 24th and 26th. We touched on both of them. 7.4% from December 26th into the end of the year. And as you can see, it just continued upward and continued upward and continued upward all the way up until March. This was the famous Steve Mnuchin price plunge protection tweet phone call to all the bankers that many people will remember. And come on off again, 5.78% going in 2019, which was just a phenomenal year. New highs, everything heading up into there. And then you had COVID. Now, from the COVID and going into 2020, the end of 2020, we were up 3.4% from December 21. Go on, go on, go on. 6.13% at the end of last year. from December 20th onward up into the end of the year, and then fractionally higher in the beginning of January, and then we dropped off. So this is where we're at right now from a daily point of view. And again, we hit that trend line up there. That was a major catastrophe. We didn't have any breakdowns in support, but one of the things that I will bring you on with is how we had that lower low that came into us yesterday from the prior low, and we have a higher RSI over here on the daily. So, something to strongly respect as you look into this, whether or not to consider the realities of a Santa Claus rally being able to not only produce itself, but more importantly, actually be able to continue into January and further, where you have the December CPI coming out January 12th. Then you have the January CPI coming out February on Valentine's Day. You have the FOMC meeting in February, and you have the other FOMC meeting in March, which, once again, very similar to 2018, from a sitting in front of the screen and watching this stuff point of view, a lot of stuff is on the table that could very well produce into a very energetic rally heading into summer of 2023. So take it as you want to, depending on what your position is. I'll use that as the word. And have a very Merry Christmas, a very Happy New Year. And we're looking for 38.55, and from 38.55, 38.80, we break above Friday's highs over there at 38.90. Then we can start talking about Santa Claus actually being here. Until we get above 38.90, above Friday's highs, above Monday's highs, we're basically sitting at a bar talking about different conspiracy theories. 38.90, we break that, then we start talking about other stuff. Have a great day. Have a fantastic weekend. Merry Christmas.